The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance.
Federal Reserve Chairman, you just saw him there, Jerome Powell, opening the door to a September rate cut on Friday. He said in that speech that the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. So what does all of that mean? Well, we're here talking with the president and the CEO of Wilsey Asset Management, Brent Wilsey. Good to see you, Brent. Thanks for coming by.
Thanks for having me.
Everybody's wondering what the Fed will do in September. Do you think he will cut interest rates?
I'm not sure. I don't think he is sure either. I mean, I think the key word, you said it, may. And the markets loved it on Friday. They rallied our portfolios way up, like, congratulations, we're happy with it. But we still have more things to look at. I heard two things in his speech. The thing he talked about was the employment numbers, and they were terrible because what happened, we had employment numbers came out at 76,000 jobs created, missed the estimate of 100,000. That was okay, but what really destroyed it was the revisions where they had in May it was what, 125,000 all the way down to 19,000, June 147,000 down to 14,000. We lost 258,000 growth on the jobs. That's what he's worried about. But you've still got the tariffs. We still don't know where that money is coming from. That's going to be a problem. That could cause more inflation. I listened to the CEO from Walmart. He's talking about how he's seeing every week prices increase. And we got to remember, they did a lot of inventory build before the tariffs. They're now starting to filter on through. And that could be a problem because with that, you see more inflation. He may not be so excited to cut rates because his job should be to keep inflation low. And if we see more jobs coming in, he may say, no, economy's fine.
So he's going to get some more data between now and the time he would cut.
Yep.
And what exactly is that? That more jobs numbers, more things like that, where we've got to almost kind of wait and see what he's going to be looking at?
We got the PCE, which is personal consumption expenditures, and that comes out on August 29th, this Friday. And they really like that one a lot. That's one of their favorites. Then on September 5th, the jobs report, that comes out. Now, if we see all these jobs that came back, he may not say to cut, and we still have about 7 million plus jobs that are open. So there's jobs out there for people to get. Some of those could be filled. And then we have the CPI comes out on Thursday, which is Consumer Price Index. That's an inflation number as well. That comes out September 11th. So if these come out different than what we had in the past, I don't think he's going to cut. He's going to say, no, I can't cut.
Let's say he doesn't cut. What does that mean for all of us? What does that mean for 401ks, for stock portfolios, for prices, for credit cards, for all of those things?
I would say be prepared for a big drop if he does not cut.
In the stock market?
In the stock market. For what it means for people individually, you know, because he works with the short-term interest rates. It's not going to change mortgage rates, but the short-term rates on your credit cards, things like that, they won't be coming down. And that's what the president wants. He wants these rates to come down so people will spend more. And if he doesn't cut, which I say I'm data dependent. I want to see this information before I see what he's going to do, and that's why I think it could have been a mistake on Friday. All the excitement, oh, you know, he switched over to our side. Let's wait until September 16th to see what he really does.
Why would the stock market go down if he doesn't cut?
Well, because the stock market sees when rates go down, people will spend more, cost of capital is less, so it's better for Wall Street with lower rates. They can do more. Higher rates are not good for Wall Street.
What do you think is going to happen with these tariffs? I was reading an article about how they're going to introduce tariffs, and sometimes you think, well, if it's 5% on certain goods, those goods will just be 5% more. And then you hear maybe they're going to do 2% on everything in the store, right? Or sneakflation, as I think what they called it, where they like sneak it in slowly but surely, right? So you don't feel it every month. It's just a little bit more and a little bit more. And before you know it, you're thinking, wait a minute, this carton of milk is a lot more than it was, 6 months ago.
Yeah, and the consumer's not stupid. I mean, they're going to see prices go up a little bit. They're pretty sharp, and they will see that. And what it means, they got to spend less because their wallet's only so big. And if inflation comes in, they can't spend as much, which is going to hurt businesses, which hurts everything. So, but we got to be careful in inflation because inflation gets out of control, that can destroy an economy. So I'm glad he was a hawk. If he's right and the numbers look good coming out, fine, let's reduce them. If not,
okay, we'll see what happens.
Wilsey
for us. Good to see you, Brent. Thanks for coming by.
Thank you.
All right. So California.